Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, August 26th, 6:02 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the big show, the blood red edition of the Revere Asset Management Nightly Podcast. Friday, we take a look back at the prior week, take a look ahead at what's important for next week, and update the world famous 21 over 21 leaders list. A little bit of a change today after the negative reaction to Jerome Powell's short speech at Jackson Hole today. I went through several cliches that I could have used to describe today, from turn out the lights, the party's over, to stick a fork in it, it's done, to Porky Pig, that's all bulls. Any of them apply today. If you check over here on the trend gauge, you can see some leaders still hanging in there. But that is just because the selling hasn't caught up to them yet. When they raid the house of ill repute, they arrest the piano player also. And the leaders that are left standing are said piano players. Just a matter of time until they get to them. I would be shocked if we're not done. This rally isn't over after a day like today and a reaction like today. We're still at neutral on market leaders because, as I said, over half of the 21-21 list did survive. We'll go over that quickly, but more importantly, this is a video to focus on process and reaction to changes, not necessarily what a leaders list looks like. So we're still at neutral on leaders, but with the red arrow pointing toward bearish / downtrend. Short term, in the span of a week, we've gone from bullish to neutral to bearish today, with the harsh break, not two closes below, but an extremely harsh break. We don't need two closes below after a reaction like today to the short term 21-day exponential moving average. Medium term, it's semantics, but we're still above the 50-day moving average, and that's just because of the rally and the recent slope of the line change relative to the 50-day moving average. I'm not really putting any weight in this. We may get a bounce when we get down to the 50-day. Long term, we failed at the 200-day 2 weeks ago, and that was a harbinger of what transpired today. So what happened? Powell, short speech, reaction, rally's dead. G6, our growth proxies, down 3.6%, S&P down 3.4%, NASDAQ 100 down 4.1%, Dow down 3%, mid caps down 3%, Russell 2000 small caps down 3.3%. Global diversified 60/40 stock bond index down 1.9, in-house GROTECTION down 1.94%. Let's get into the charts. Let's get into the tail of the tape, but let's get into why we do what we do here at Revere. And I want to bring in my Twitter feed and two tweets that I posted after the market today. The first one was got stops, because we sure do, and it's a classic scene from Ron Burgundy after they had a deadly street fight in the alley between two warring TV channels. Ron sitting there saying, boy, that escalated quickly. I mean, that really got out of hand, and that really describes the action today. The second one that I posted was the chart that I have an intimate relationship with, describing bear markets, how harsh they can be, what it takes to get back to even. My comment is a reminder: pie chart salesman advisors will not protect your portfolio during bear markets. Some wish they could, others proudly and defiantly refuse to. Take a look at these numbers. Some people are okay with these numbers. Some people in my profession are okay with these numbers. I'm not. I don't have to be, and you don't either. Severe bear markets. Here's what we've suffered so far in this sell-off. Worst case, down 24.5%. We're back to down 15% year to date now. on the S&P 500. If we get into the severe category, which means 30% loss or more, on average 44.5%, 6 of them over the last, going back to 1968. Takes 80% to get back to even. You're approaching retirement. You don't have time to get back to even. So what we do here at Revere is follow the trend. We use 3 time frames. Short term, the green line here, 21-day exponential moving average. The red line, intermediate term 50-day moving average. The black line, the 200-day long-term moving average. We look at all 5 of the indexes and where they are relative to that, and then we look at how leading stocks are behaving. When things start to roll over and go badly, we take corrective action, reduce our exposure to the market. Things get really bad, we'll go completely to cash. And when I say really bad, that means we're below the 200-day moving average. This is where all of those bear markets occur. This is where risk is the highest. When you're below this black line, the 200-day moving average, we failed into this magical black line 2 weeks ago, and had a fake rally yesterday, but all that was indeed a bull trap as we broke decisively below the 21, decisively below the prior lows of this week, decisively below 4,100 support. And it's an absolutely stick a fork in the rally scenario. I mentioned yesterday a little tick up in the stochastics for the indexes after this nice move back above the 21. That nice move lasted less than 24 hours. We're headed toward oversold now in the stochastics, and we're headed toward the 50-day moving average. We'll see what, and 4,000, that's a pretty big level. It's provided some support in the past. I would think that we may pause there. I said think, I hate saying think. Odds favor we might pause there. It doesn't matter what I think. The market's going to do what it's going to do. My job is to interpret it, grow capital when the wind's at my back, protect capital when the wind's at my face for our clients, and that's what we do. We're down about 5.6% on the year. The S&P 500 is down about 15% now. At worst, it was down 24%. At our worst, we were down 8.5%. And I said early this week, we've made enough gains during this rally that if it rolls over, we'll be out with at least a profit, and we will be. So we'll see what next week brings, but my inclination now is to take any profits that we have left in the holdings, and actually everything that we have left is at a profit, but to lock those in tight and wait for better days. So there's your S&P 500. Let's go to the NASDAQ 100. We'll go through all 5 of the big index charts. Why is that? Because 75 to 80% of the stocks in the market will follow the trend of the overall market. NASDAQ 100, same thing, fake break above the 21 yesterday, harsh break today, coming into the 50-day moving average. Same thing with the stochastic. Dow Jones Industrial Average, same thing with the stochastic, false break above the 21, hard break below on volume coming into the 50-day moving average. Mid caps, they had been outperforming somewhat lately, failed into the 200, failed above the 21, broke below the 21 today, new weekly lows. Still the best acting and still showing some relative strength for the week, but same stochastic setup, just not quite as bad. Small caps, failed break above the 21, close below it, close weekly lows, same stochastic setup, still looking a little bit better, some relative strength this week, but that should be looked at as the exception, certainly not the rule. So let's get rid of the stochastics so we can focus on the charts a little bit more. And what I want to take a look at is the tail of the tape. We'll update this, a lot changed here, and then we'll dive into some individual stocks. So headwinds, in addition to the big macro, strong dollar, inflation, Fed tapering and their balance sheet reduction, interest rates, Russia-Ukraine war, we've got the dollar at 5-week highs. It was up today. The only 2 things on my screen that I could find of consequence that were up today were TLT, that's long-term treasury bonds, as money flowed into them as a defensive tool, and the dollar, the US dollar, which is not good for stocks. So talked about this NASI hook down from overbought. That's a McClellan summation index. That's an additional relative strength. And then here's the 5 major indexes, daily stochastic rolling over and heading toward oversold now. Put call ratio at 1.0. This can go a lot higher. VIX up 17% today, above the 25 area and rising, and it's now above all its moving averages. That's a negative. Fear and greed down to 44. That's mild fear. We can go a long way down to extreme fear. Bull case is over, 826, big break below the 21. Bear case is in effect. Powell reaction kills the rally. So some news today, a little bit before the market, we actually went red pre-market as at 8:30 PCE inflation data came out and inflation cooled a little bit. We are up about 1/4%. That faded to a flat open. Also some good news on some China stocks as U.S. and China agreed to some audit rules on China stocks that are listed on the U.S. exchanges, but that faded badly. KWEB was up big. About 4 or 5% faded to negative by the end of the day. So Powell's speech was short, sweet, and painful. Some of the quotes in there were that he said we plan to use our tools forcefully and there will be some pain, and the market reacted accordingly. You know, it really wasn't that much different from, I think, what anybody had been expected, but he was more forceful in his speech, and the market, my notes were, yikes, look out below. But I mean, what else could you really say about the reaction? My expectations were neutral. With Powell coming into today, wanted to see how things broke, and they broke to the downside. My expectations are now negative going into next week. Support and resistance on the NASDAQ and the S&P 500 down hard through multiple support areas. Trend down, frozen slope to close at the low of the day. So frozen rope is when you are heading up with very little resistance, kind of like we saw in this move off the lows. If you look at a 5-minute chart for today, frozen slope is just the opposite. We had this shakeout, breakout, quick drop, and then just look at the selling in the afternoon. Frozen slope lower, absolutely no buyers, no rally to sell anything into. We had this little cup, maybe it was a reprieve intraday, nope. From 1 o'clock into the close, just hard down, frozen slope lower. Here's the S&P 500, pretty much the same thing. So let's see what else is new. 11 out of 11 sectors down. Semiconductors, biotech, gold stocks, and home builders hit particularly hard. My focus list coming into today means absolutely nothing. We sold a lot of positions today. I'll go through those charts, and then bottom line, I said whatever cliche you want to lose, stick a fork in this rally, sell any strength. So let me move up here and look at the next resistance levels, and then I'm going to slide this away, and we're going to look at the charts and what we bought and sold today in the portfolios, and then we'll go over the 21 over 21. So here's our prior close all the way up here at 41.99. I haven't updated this, but these will all be red as of next week as we broke through every one of these resistance levels to where we closed today at 40.58. Next level down is 4,000, which was, there was a Fed pivot on 727. This is when we started the rally higher. And March of 2021 breakout was this 4,000 level. That's the next level of support. That also coincides pretty much with the 50-day moving average. So I'll have to add some more lower key levels of support below here for next week. So let's take a look at first of all what we did in-house today. The first move we did was take off some SDS. This was a hedge. So when Powell finished, the market was like, "Hey, yeah, we expected that, no big deal." This was, I called this a test tube and handle at first. Let's take a look at it at a 1 minute chart. You can't see it on a 1 minute chart, it scrolls off, but harsh drop, harsh pop. I thought, I mean, it looked like we were going to go higher. I took off some of our hedge, got a little bit longer, and immediately that rolled over. So that was looking like a mistake. And then we broke below the 21 decisively, and we kept cutting through levels. So what I did is just reverse the trimming of SDS by trimming SSO. We took off 3 tranches of our SSO long. The one yesterday that we bought on when we went above the 21, so that was sold for an extremely small loss. about 0.1% of the overall portfolio. Then we took a 11% profit on the buy of SSO from, I think it was 8.19, and then a 10% profit on the buy from 8.17. So we started reducing our SSO position as we continued to go lower, and then we added, when we started breaking down here, we added SPXS, which is a short against the S&P, and we'll regroup on that when I say when, I mean, that sounds like I have my mind made up and I know what's going to happen. I really don't, but based on what I'm seeing, we're headed toward the 50-day moving average, this frozen slope. Let me explain why I think that we're doing what we're going to see again. Take a look at this day here. Today reminded me of this day here, 421, where we were kind of rallying. We broke above, we got above the 200-day moving average, boom, and had a very hard reversal after that. That led to a big, another bout of selling the next day, little bit of consolidation before another leg lower. That also reminded me of this day, 6-9, where we consolidated for a little while. People were getting excited. Hey, maybe, nice tight consolidation. Maybe we're going to break higher. No, we broke lower. And then the next day we gapped down, and that was another leg lower. This day just looks too much like those 2 days. And the fact that we're under the 200-day moving average leads me to believe, combined with the frozen slope action in the afternoon, that we're going lower. As I weigh the evidence, that's the conclusion that I come to. It just looks too much like those 2 days action when it just, any short-term strength that we were having was just reversed in 1 day, and then we ended up with another leg down. So that's my thought on why we were so aggressive getting rid of our SSO and adding SPXS. That's a 3-time short to our portfolio today. Now, let's talk about when conditions change, and they did change very quickly after that, the reaction of the press conference today. The first thing you do is go and reverse in your portfolio. We take a look at things we bought recently. Where are they? And if they're red, get rid of them. So yesterday we bought Plug. We got rid of that. Small loss. Again, less than 0.1% versus the overall portfolio. Prior buy before that was Pan W. Small loss, about 2%, less than 0.1% to the portfolio. I already mentioned the SSO that we added yesterday. We took that off right away. Then we start looking at where are we on our rest of our positions? Where's our stop? Are we red on anything? Where's support? I mean, we kind of already know these things because we keep track of what our overall risk is, but we just keep chopping away at the weakest stocks and see if the strongest can continue to hold up. And if they can, we'll stick with them or maybe trim a little bit to lock in some gains. So BJ's, we were down to a 1% size on this. It was red, so that went away. Apple, I learned a lesson. People said, "Why it's Apple? Why sell Apple?" Well, we bought it on this gap up on earnings, and it continued to act well, and then it started to roll over. Still held to 21. I said a couple times that 21 was my stop on this. It broke to 21, and I sold it. I learned a lesson from PayPal back in the early spring of 2021. PayPal was a big leading stock. Titan in its industry, and it just lost 20% in like 4 days, and never again, just because of the ticker of a stock, will I hold on to it just because of the ticker. So we blew Apple out. LNTH, we had a 1% position left on this with a 12% gain. We got rid of that. Really, we're looking for things as they broke below the 8 EMA. I didn't want to give them down to the 21. Enphase, small gain on this, locked it in, broke the 8 EMA. ON, one of the strongest stocks in the market, broke its 8 EMA. Very long, big gains yesterday, gave them all up today. Very volatile stock. Don't want to wake up to another 5% loss on this. We booked a small gain on this. Wolf, cut this in half. All 4 buys were profitable. We took the most recent 2 buys off just to reduce risk. And now we've got 2 buys with mid-single digit gains still. We're just not going to let these things go red. So I mentioned SSO selling and the buy of SPXS. So that our Revere volatility adjusted beta coming into today was 1.34 or 34% more than a full portfolio of the S&P 500. We exited the day at 0.34, so we took 75% of our risk off today. A combination of defensive selling, cutting losses, not really any offensive selling because we were just dropping all day and protecting profits and cutting losses. So bottom line, as I said, stick a fork in this rally. It's done. Let's take a look at the 21 over 21 list now. And I didn't bother replacing stocks because I'm not going to be buying anything next week until the market makes a decision that it's finished going down or some basis form or what have you. But let's take a look at the 7 things that did not survive from last week's 21 over 21 list. AMT closed below the 21. Apple, already talked about that. Sold that as it broke below the 21. CDNS, Cadence, broke below the 21. Note the volume on most of these is high also. CNC got an early downgrade. Broke below not only the 21 but the 50 also. Net broke below the 21 after consolidating. MPWR, we sold this earlier this week when our stops were hit, broke below the 21. And Vertex, VRTX, below the 21. 3 that were added this week were things that we bought. They're still above the 21, so they're still on the list. Plug, still above the 21, but we sold it. PanW, still above the 21, but we sold it. Exxon, still above the 21. We're still holding on to that. We bought that this week. So 21 minus 7 is 14, plus 3 is 17. We've got 17 on the list. Let's go through them very quickly. We're still holding 4 stocks. LNG, still holding this. As long as it holds the ADMA, we won't trim any of that. Shockwave continues to act well above the ADMA. We still have our position in that. LNTH, as I said, we closed that. Enphase, we closed that. ON, we closed that. PWR, still acting fine. Celsius. Celsius sold hard right out of the gate today, but really acted well as the market continued to come down. This is what I'm talking to, this big shakeout, some big selling, shook a lot of people out. It bounced nicely. Everybody was happy. Powell finished speaking, and then it tried to sell off again, but showing strength while the market was going down. Then it did fade some into the close, but I will give Celsius an A today for that action. CMG had this is on my top 5 to buy all week. Won't be buying it. Still above the 21 though. Oxy continues to be strong as Warren Buffett loves it. CEG acting great. ANET basically right on the 21 with this close. Wolf, we still own this. I talked about that. GFS, we got stopped on that early this week. Still looks fine above the 21. BJ's still above the 21. We did sell it though. Exxon still holding this. Palo Alto, we sold it, but that still looks fine. Plug Power, we sold it, still above the 21. And that's it. That is it. So that's going to wrap it. As always, love to hear from you. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. You do not have to be at the mercy of the market, giving back your nest egg, giving back profits that you've made. You can cut losses. We're below the 200-day moving average. We know that risk is at its highest with the market when we're below the 21-day exponential moving average. If you're not protecting yourself, ask yourself why when you do it in every other aspect of your life. And if you're interested in talking to us about managing your portfolio, there's the contact info. We're always here for you. If you have any questions, also you can reach out. So that's going to do it. Wrapping up the week ending 8/26. This is Don Vandenbord. Don't shoot the messenger. Telling it like it is. Just the facts here at Revere. Remember, it's not how much you make, it's how much you keep. Thanks for listening and have a great weekend.